All right, welcome to another day. What we're going to do today, this is a little bit unique to not-for-profit accounting on the CPA exam. Most areas on the exam, they're just testing the general rules. It doesn't really have anything to do with specific industries. But in not-for-profit accounting, they do focus on two specific industries, and they'll ask questions that are kind of specific, saying that a lot, but to those industries. And so you kind of just need to know some rules related to them. So that's what we're going to do. It's primarily revenue recognition, but you'll see kind of it's related to anything in that area. So first off, educational institutions. So think of these as not-for-profit educational institutions. So not necessarily Truman, we're a government entity, but examples of your not-for-profits would be like private schools, whatever private schools you can think of. I mean, Western Governors or Notre Dame or Creighton or whatever. Anyway, so not-for-profits. Okay, so this initial definition, this is common for everything. Okay, for all not-for-profits. So increases in net assets without donor restrictions and donor restricted resources that were expended during the period. Okay, so that's going to be true. That's what we consider revenue. Okay. And so some examples are student tuition fees, government aid grants, contracts, gifts, private grants, endowment, income, and different types of services that an institution sells, or things like publications, testing services, food services, resident halls, athletics. So all of that is considered revenue. Okay. So your student tuition and fees, this is where it seems like they kind of test around this concept a little bit. So they're reported at the gross amount, assessed student tuition and fees minus canceled classes is what your gross revenue would be. Okay, so what they try and do is they get you to include in other things to subtract off the gross amount. So you just start with the assessed student tuition fees, and then any kind of refunds for tuition or canceled classes, subtract those off, but that's it. Don't subtract other things. And that gets you to your gross revenue. Okay. Well, I kind of repeated this. But what I wanted to do on this slide is, so these other things, so like scholarships, tuition waivers, similar reductions considered either expenditures or separately displayed allowances reducing revenue. So they'll say like discounts for discounts for the kids of employees or something like that. Okay, that doesn't reduce down the gross revenue. Okay, only thing that reduces gross revenue is canceled classes or like reimbursements. Like if a student drops a class and we have to reimburse their tuition. Okay, all of these other things, scholarships, tuition waivers, other reductions, those we record as expenses or allowances. Okay. All right, so that's pretty much it on universities. Okay. Well, really, that's universities, or I mean, it could be K through 12, private schools or whatever. Anyways, educational institutions. Okay, healthcare revenue. This is probably a bigger area because there's just kind of additional things, but you'll see they're still testing the fundamentals. They're just testing those fundamentals through questions about healthcare. Okay, so similar, accounted for on the accrual basis, established standard rates. So they'll say things like the standard rates or customary fees. Okay, and so even if the full amount isn't expected to be collected, we still bill at the standard rates or customary fees. That's what we recognize the revenue at. So again, all income earned plus amounts released from restrictions or reported as revenues, gains, other support without donor restrictions. Okay. So there's two different things they can ask for. They can ask for net patient service revenue. And in that case, what we're going to do is we're going to start out with our customary fees or our standard rates. And then we're going to do subtractions for contractual adjustments for third-party payments. What this is insurance companies, you can bill them whatever you want, whatever your customary fees are, but they will subtract, they'll basically, if an insurance company has enough buying power, if they're big enough in the market, like they'll pay essentially whatever they want to pay. Normally they're negotiated, but anyway, so that's your contractual adjustments. Policy discounts, self-explanatory. Administrative adjustments, so employee discounts. And then this one here, this is a little tricky. So bad debts for services provided before the ability to pay was assessed. So basically, if we provide services, someone comes into the emergency room, we provide services, okay, save their life, whatever. If we haven't assessed their ability to pay, okay, then that reduces net patient service revenue. Okay, you're going to see a difference here in just a second. So these four things here reduce net patient service revenue. Okay. And then there's this other concept that is actually, I haven't seen this tested before, but it may be on the new version of the exam. So it's called capitation agreements. And basically all this, in my mind, all this is, and so it's saying fixed amounts paid periodically by patients. So think of if a healthcare provider is providing services to a company, and so the employees of that company, they pay in a specific amount, typically monthly, and then they receive care from that healthcare organization. So it's kind of like health insurance, but coming directly from the healthcare provider. Okay, so we consider that a form of revenue for the organization, which makes sense, right? I mean, it would be similar to doing like a subscription plan for Netflix or something like that. We would recognize revenue as we provide the services, okay, over the period of time. Okay, charity care. So now this is different than this bad debts for services provided before the ability to pay to assess. Okay, what charity care is these not-for-profit organizations, they will have a policy and they will say like, hey, there are certain people we're going to provide care to, and we don't expect to be paid. Okay, now remember, revenue recognition, there's two things that have to happen in order for us to recognize revenue. We have to provide the good or service. In this case, we're providing care. Okay, but the second thing that has to happen is we have to expect to be paid. Okay, or we have to believe that that the person receiving our good or service has the ability to pay us. Okay, if both of those things aren't true, then we don't get to recognize revenue. Okay, so you see how that's like the fundamental definition of revenue? Well, that's what they're going to test, and they're going to do problems about charity care in order to test that. Okay, so if we're providing charity care, we don't expect to be paid. Therefore, we don't recognize revenue. And so it reduces patient service revenue. So this one here is, it's reducing net patient service revenue. This is different. They're like, we don't recognize the revenue at all here. Okay. So what does have to be provided is because this isn't going to be part of revenue, it's going to actually reduce revenue. then we need to provide information in our financial statements about it. So we have to describe what our policy is for providing charity care, the level of care that's provided, the notes of financial statements, and then down here it's just saying like don't record this ever as a receivable or revenue, and don't record it as bad debt expense. Okay. Okay. Now, an example of bad debt expense. Okay. So this is a little bit different than this one here. The reduction in net patient service revenue. The difference here is if we have screened the patient for their ability to pay, so we believe that they're going to pay. So this is different than charity care also. So if we screen them for their ability to pay, and we thought they were going to pay, and then they didn't end up paying, or really, if we made an estimate for like the percentage of accounts receivable that we're not going to collect, and then we debit bad debt expense and we credit allowance or uncollectible accounts, right? Anyways, collectible accounts, blah, blah, blah. Uncollectible accounts. This amount here does not reduce revenue, gross revenue, and it also doesn't reduce net patient service revenue. It's actually recorded as an expense, bad debt expense. Does that make sense? Hopefully it makes sense. Happy to explain that better if I need to explain it better. Okay, so revenue recognition, patient service revenue, that is the main area that healthcare organization is going to receive revenue from, right? So that's just everything the hospital provides as far as the healthcare services. It's the major or central operations of the provider, okay? So it's kind of interesting. They're going to ask questions about like what is patient service revenue and what is other revenue, stuff like that. So you kind of got to have this down. So this is like when you think of a hospital, this is the main things you think of. So the doctors providing care, doing surgeries, room and board fees, and recovery room fees. Okay, so your basic, what you would think of as a hospital, what they provide. Okay. Then there's this other category, other operating revenue. Okay. So think of a hospital that's also a school. So like University of Missouri healthcare system, or I'm sure like things related here in Kirksville related to ATSU. Anyways, so the tuition from the schools, that's considered other operating revenue. Revenue from educational programs would be like providing seminars, things like that. This one here, I underlined it in black because it's just a little tricky. I don't know why they do this, but and donated supplies and equipment is going to be other. Okay, so donated supplies and equipment is other. Grants, auxiliary services, cafeteria revenue. Remember that one? It seems like it gets tested too. Parking fees, gift shop revenue. Those are all other. Okay. Now, if you look at this one, this is non-operating revenue and support gains and losses. Okay. So interest and dividend income from investments, gifts and bequests. Okay. So don't think of donated supplies, but think of gifts, grants, income from endowment funds, income from board designated funds, and then donated services. Okay, so donated services are non-operating. Donated supplies are other operating. Just a little thing you have to kind of remember. Okay, let's go through some practice problems on this and then we'll be done. Which of the following should normally be considered ongoing or central transactions for a not-for-profit hospital? Okay, room and board fees, yes. recovery fees, yes, so both of those. Cool. Valley Community Hospital normally includes proceeds from the sale of cafeteria meals and, remember that? So cafeteria was in other revenues, right? Let me go back here, cafeteria, other revenues. So this kind of is stuff you have to memorize. I apologize. Okay. Not-for-profit organization with no governmental affiliation reported the following in its accounts for current year ended December 31st. Oh, that's one thing to be careful with. No governmental affiliation. So University of Missouri Hospital, obviously that's a state institution, a state hospital. Okay. But ATSU there, that one's private. Okay. So there is a distinction there. All right. Before I go through all these different numbers, I want to jump down and see what it's actually asking. What amount should the hospital report as net patient service revenue? Okay. In a statement of activities for the current year ended December 31st. Okay, so gross patient service revenue from all services provided at the established billing rates of the hospital, $775K, but it includes charity care. Remember, we never record charity care as revenue, so we need to go 775 minus 25, so we're at 750. Not the best sevens, are they? Okay, so we remove that, right? Provisions for bad debts. Remember, those provisions for bad debts, that's going to be recorded as bad debt expense. It doesn't reduce net patient service revenue. So we don't do anything with that. Well, we record it as bad debt expense. Difference between established billing rates and fees negotiated with third-party payers. Okay, so that's your insurance agent, insurance companies negotiating better rates. So remember, we do subtract that off to get net patient service revenue. So 750 minus 70 gives us 680. We're not good at my math there. 680, but cool. Okay. Oops. Next one. Oh, dang. They're gonna try and erase. Oh, never mind. Oops. Okay, I got rid of them. Better to just read through it. Okay, Delta Hospital purchased medicines from Field Pharmaceutical Company at a cost of $5,000. However, Field notified Delta that the invoice was being canceled and the medications were being donated. Okay, remember donated medical supplies. Delta should record this donation as memorandum entry, no. Other operating revenue, credit, no. So other operating revenue, right? Remember, donated supplies are other. Donated services are non-operating. Which the following normally would be included in operating revenues. Remember, this is like the main, what the business does, right? So revenue from educational programs. Oh, no, so sorry, other operating revenues. Be careful with that. So not just operating revenues, but other operating revenues. Okay, so revenue from educational programs, yes. Gifts without donor restrictions. Remember that one there was non-operating, so it'd be yes and no, D. For the fall semester of year one, Ames University assesses students with students $3 million for tuition and fees. The net amount realized was only $2.5 million because scholarships of $400,000 were granted to students, and tuition remission of $100,000 were allowed to faculty members' children attending Ames. What amount should Ames report for its gross period, or for the period as gross revenues from tuition fees? Okay, so $3 million. And remember, the only thing we subtract from that is if we have to reimburse tuition and fees, like if you cancel class or they drop classes or whatever within the drop period. So the $3 million, these two things are going to be recorded as expenses or allowances. So it's $3 million. State University assesses student tuition and fees totaling $500 or $50 million for year ended June 30th. However, its net cash collections were only $42 million as a result of following reductions. In this situation, revenue without donor restrictions from tuition and fees for year ended June 30th for State University will be reported at, okay, so we start at 50, okay, and then scholarship, tuition, remission, fellowships, okay, that's all going to be recorded as expenses or allowances. So, but tuition refunds, that does reduce the gross amount, right? And so 50 minus 1.5 would be 48.5. So this person's performing test work for a not-for-profit hospital. This is saying State University, but obviously it's a not-for-profit university. Listed below are components of the statement of activities. The way you would know, sorry, I'm going to go back to this one. It would say, like, normally on these problems, it'll say non-governmental, not-for-profit, or it'll say a governmental entity, or something like that to help you know, like, hey, I need to use governmental rules, or I need to use not-for-profit rules. But it's interesting, governmental, they don't really do industry specific, like, yeah, it's just governmental accounting in general. So normally just in the not-for-profit, they do industry, specific industries. Okay, so we're doing test work for a not-for-profit hospital. Have some different components on the statement of activities. What amount would be reported as revenues, gains, and other support without donor restrictions on the statement of activities? So revenue related to charity care? No, we don't recognize that at all. Bad debt expenses associated with accounts assessed for collectability. Remember, if they're assessed for collectability, then it's just a bad debt expense. So that wouldn't. Net assets released from restrictions used for operations. That is, remember, it's one of the two. Other revenue. Yes. Net patient service revenue, but it includes charity care. So not really that. We need to subtract off our charity care. Now we go 400 plus 80 plus 50. I guess. So, sorry, so 400 plus 50 plus 80, 530. See. Cool. All right. Altruistic university, not-for-profit research university, conducts cancer research as part of its normal ongoing activities and regularly receives contributions to support these efforts. Experimental Pharmaceutical Corporation, a large for-profit corporation that markets drugs for cancer treatment, provides resources to Altruistic University to perform clinical trial research on an experimental drug to treat cancer. Resources are provided on the condition that Altruistic University comply with strict specifications governing the manner in which the research is conducted and the frequency and character of outcome reports. Altruistic University should account for the resources provided by experience. Okay, perfect. So basically it's just saying, like, hey, how should we account for those resources? Now remember back, probably, I think it was the first PowerPoint that I did for you, we talked about exchange transactions versus non-exchange transactions. So remember, an exchange transaction, that's like what we take part in every day, right? Whether you bought gas this morning or whatever, if you bought something today. or paid for some type of service. Those are exchange transactions. And if you look at this closely, this is resources are provided on the condition that altruistic university comply with strict specifications governing the manner in which the resource is conducted and the frequency and character of the outcome reports. Okay, so what this is saying is they're going to pay experimental pharmaceutical is going to pay the university money, but the university has to do this research and follow their specifications. Okay, so this is definitely an exchange transaction. So if we look through these answers, a contribution that increases net assets without donor restrictions, provided restrictions are met in the current year, university uniformly applies. So, I mean, this can be an answer in some of these questions when we receive contributions that have donor restrictions, but then we meet the restrictions in the same year. But that's not what's going on here. Okay, this is an exchange transaction that increases net assets without donor restrictions. So everything else is a contribution, or we want to do exchange transaction. Okay, so that's all of them. Hopefully that was helpful. Let me know if you have any questions. Thank you for watching. Back to Zoom.